The irony of passive income is that they're not really passive at all. Your money will perhaps grow to a greater extent over the long term, but that's not really what you're looking for. Tax-free investing vehicles can be a massive, massive help on your way to building wealth. So everybody talks about building wealth these days, but what do they actually mean, and what is the way to build wealth? Is there a correct way to build wealth? Well, I'm going to talk a bit about that in today's video. I'm going to look at probably the two most common wealth building strategies, looking at asset appreciation and capital gains versus passive income. So let's get right into it. So asset appreciation, I would say, is investing in assets that appreciate in value. That means their value increases over the long term. And as a result of those increases that happen over the long term, that's how you expect to increase your wealth, build your portfolio, and increase your net worth, essentially. So through the appreciation of the assets in your portfolio. Contrast that with a passive investing approach for building wealth. So what we call passive income is essentially income that doesn't come from the direct result of work. Essentially, you invest in an asset that produces an income for you, and then that income is what you then use to essentially build your wealth. Whether you reinvest that income, or it might even be the case that your passive income is funding your lifestyle, or part of it at least, if you have a significant amount of passive income, as we call it. So if we were to think about what asset classes would generally appreciate over the long term, we would perhaps think of, index funds that track a stock market index, or an ETF that does the same thing. Real estate typically appreciates over the long term as well, and perhaps cryptocurrency as well for some of the more experienced or higher risk investors as well. And then thinking about the kind of assets you might have if you are looking for passive income, again, real estate, but perhaps the difference would be is that you have a rental property, or you're investing in a real estate investment trust, a REIT, or you might be investing in particular stocks that pay a regular dividend so that you can benefit from that income every time a company that you invest in pays a dividend. So you can see there is a little bit of overlap. As we say, if you're getting rental income from a property, then not only are you getting that rental income, but the property does increase in value over time as well. You've also got index funds and ETFs that pay out dividends, but of course, the main probably expectation is that you're looking for them based on their potential for appreciation over the long term. So which approach is right for you very much depends on a number of factors, and I'm going to break through some of these factors that you should consider when determining which investment strategy to pursue as you look to build wealth. So the first thing is all to do with your goals and what you essentially want from your investing. The reason behind your investing, why are you investing? Now there's a number of reasons why people invest. There might be people who are investing their money to try and build up a portfolio and a nest egg for retirement in the long term. People may be investing to diversify their income streams and to create additional sources of income, or people particularly recently might be investing simply because they get a better return on their money than they would if it was sat in a savings account in the bank. And another big factor to take into account here is the potential compounding effect. So the earlier you start, the greater the potential of compound returns over time. I'll put a graph on the screen just to show you kind of what that looks like. There's this graphic that the Money Guy show always presents on their show, and I think it really beautifully demonstrates the power of compounding over time. So maybe to give an example, a young person who is looking to begin saving very, very early for retirement, and they want to have the biggest possible nest egg and biggest possible net worth as they get later on in life. So obviously, because of the compounding effect, then investing in capital appreciating assets such as might be an index fund that tracks the stock market would have, generally speaking, the greatest potential for capital increase and for that to be able to grow over the long term as well. Now, would that same approach work with someone who is trying to diversify their sources of income and generate new sources of income? Probably not to the same extent, because yes, of course, your money will perhaps grow to a greater extent over the long term, but that's not really what you're looking for. You're looking for income in the short term. So instead of investing in an index fund, you might be looking more at stocks or ETFs that pay out dividends, for example, or real estate investment trusts that pay that regular income so that you have your new sources of revenue. Did very briefly touch on the return there. So of course, not only is there the compounding effect, but if you look at the performance of the stock market, the S&P 500 over the last several decades, you'll see that it averages about 8 to 10% annually, whereas a realistic good yield for example, a dividend paying stock or real estate, it might be somewhere in the 5 to 7% ballpark. So you have got higher returns on some of those assets that are more focused on, appreciation over the long term, but in sacrificing some profitability in the dividends, you've got income coming in the short term. So of course, what you decide to do will very much be determined by your goals and your investing needs, essentially. The next probable consideration you'll have is the time commitment. So how much time do you need to be spending analyzing, monitoring, tracking your investments? Because the irony of passive income, if you look at what kind of assets will give you what is known as passive income, is that they're not really passive at all. If you're investing in real estate, rental properties, then even if you have, someone managing the property for you, then you've still got to do your research on, the neighborhoods that you're buying and the property that you're going to buy. You still got to pick out the tenants. If you got an administrator, then they'll probably take care of some things for you. But there is still a lot of work that goes in behind the scenes for properties. The same goes for dividend stocks. You can't just pick a company out of a hat that pays a dividend and roll with it. You should do your research properly before you buy to make sure the company's right for you and that it meets your expectations in terms of the timing of the dividend payout, whether it's quarterly, twice a year, annually. All these kind of things you gotta keep in mind. Compare that with something like index fund or ETF investing. There's very little time required there. You can have a quick look over the documents on a fund, understand what's in it, and you can set up your investing on autopilot and just let the compound interest magic do its stuff. However, you do have a different kind of time commitment with these, which although you don't need to spend the time analyzing and investing to the same extent as you would some of the other assets I just talked about, you do need to be locked in if you really want to reap the full benefits of compound interest. And the last point I want to talk about, which I think a lot of people probably overlook, are the tax implications of these strategies. Now, tax is complicated to the point where, for example, a passive investing strategy may work well in one country and the asset appreciation strategy may not work well there. Whereas in another country, the asset appreciation strategy may work really well and the passive income strategy may not work. So one factor that you need to consider, of course, is where you live. Generally speaking, capital gains are only ever taxed, at the point of sale based on the difference between the price you bought an asset at and the price you sold it at. You may, however, end up living in a country where there are zero taxes on capital gains. Two examples in the EU are Belgium and Cyprus, where you can sell an asset, at a higher price than you bought it, and you won't pay capital gains if that's your fiscal residence. And if we consider cryptocurrency under capital gains as well, then again, the taxation will very much depend on what country you're in, and of course, legislation could change at any time. If we're talking about dividends, then typically there is some withholding tax on dividends paid out. So, for example, if I'm in Spain and I receive a dividend from a company in the Netherlands, then that dividend will come with tax withheld in the Netherlands. But what it's always worth doing is understanding if those two countries have double tax treaties, because if they do, then that will help you avoid being taxed twice, and you can essentially claim tax credits in the country where you're fiscally resident. But of course, as I say, very much depends on the tax regime and if countries have double taxation treaties. And then rental income, that'll very much depend on, the country's tax system as well. If it's treated like dividend income, or if it's or if there's a special, tax bracket system for rental income as well. Now, once you understand your tax liabilities based on the assets you currently have, what you've sold, what income you're getting from dividends or rental income, most countries will have some kind of provision in their tax system where you can offset losses, so do some form of tax harvesting. And this is not tax advice, and of course how this works and to what extent you can make use of it will very much depend again on the tax system of your country. For example, in the US, you can use investing losses to offset your taxation from earned income, whereas in Spain, for example, earned income and investing income is always treated separately, so you can only ever offset investing gains with losses in Spain. You can't use it to offset earned income. But essentially how this loss harvesting works is, let's say, for example, I made capital gains of 10,000 euros and I have investing losses of 1,000 euros. And let's say that from 9,000 euros of gains upwards, I pay a higher tax rate. Well, what I can do is I can use those 1,000 euros that I've lost to offset the gains from the 10,000 euros and bring me back down to the 9,000 euro tax burden, just to give you a simple example. And of course, you want to consider if there are tax efficient products available in your country, such as this is the case in the UK with the ISAs or in the US with the 401ks and Roth IRA investing accounts, because tax-free investing vehicles can be a massive help on your way to building wealth. So a lot of information shared there, guys. I hope it was helpful, and I hope it's given you some food for thought when thinking about your investing strategy. Leave a comment and let me know, what are your investing goals and which strategy have you taken to try and reach your goals? Till next time, I'll see you on the next one, and let's get this money.